Hello, it's Craig tapping from Master in the Markets, just taking you through a quick snapshot of what I'm seeing in the markets right now. So it's been a busy week, and what we've had is we had the markets sort of taking precaution and de-risking going into the Fed meeting this week, and the Fed held rates. So even though it wasn't a unanimous vote and it was a 9-3 vote to hold rates, we did see rates being held. And the Bank of Japan did their rate review today, and the Bank of England did theirs yesterday. And all three big central banks have made a decision to hold rates, which has been a bit of a release, a pressure valve release in the markets. And you've seen a little bit of the markets react in terms of having a little bit of a risk on event. So what am I seeing in the markets? I'm seeing a little bit of a bounce, and this is the S&P 500. And what we were looking at in the S&P 500 is we were looking at a potential that we could lose the support. But we've held the support. We once again have made a higher low. So even though, this consolidation in the symmetrical triangle continues, and a triangle generally is the last consolidation before the final move up. And we're keeping this alive as long as this triangle doesn't break down, and we continue to complete the triangle, and we have a chance of breaking up and putting in a new high before we actually have a bigger, broader correction. So the Fed will meet again in September, and in September they'll be armed with July and August's CPI data, and they will obviously make a decision based on what is happening with inflation by then. But at this time, we've bought some time, and the markets will continue to sort of grind higher potentially as long as earnings are good. Earnings as well has also been we're sitting at a incredibly high beat rate. We're sitting at an 86% beat rate so far out of all the earnings that have been reported. And what that's doing is that's giving confidence that the valuations in the market that we're seeing are not ridiculously high or not being supported with good earnings. And just in this last week, we've had some big results like Meta, Microsoft. We've had the big report from Apple and Amazon as well. And they've certainly been rewarded when the companies have outperformed, and they've certainly been crucified and have been hit down quite hard when they have not quite met expectations. So I think what we're seeing in the market is we're seeing a market with really, really high expectations, but really rewarding good results and really rewarding good performance and good future outlooks, but starting to punish ones that either are just making it or just missing it. So what I'm seeing in the markets right now is the S&P 500 continues to make higher lows and continues to keep the hope alive of potentially going in and putting in a new high as this triangle pattern plays out. What we're seeing in the NASDAQ is we have seen a bit of a move down. So what we got is we got a change of market structure. We had the high, we had a low, we had a lower high, and then we've had a bit of a breakdown. And what this looks like is a little bit of a regular flat correction. So we've had three waves down, three waves up, and we've extended in a C wave that has almost been a 1.618 extension of A wave, which could be a completed correction. What we need to watch now is, do we get a reversal or do we get a small sort of recovery bounce, what we call a sucker's rally into resistance, and then see further moves down? And that's what we really need to determine. And it's a little bit premature, but we would be watching this sort of area of the NASDAQ to see if we get rejected. Looking at the Dow Jones is still looking strong. We continue to make higher highs. We continue to respect current support levels, and we're getting a really good bounce off there. So at this stage, until we sort of break structure, the Dow Jones is still looking quite strong. Looking at the Russell classic rising wedge or ending diagonal into a top with this is probably where we've seen the most amount of weakness in momentum. The RSI showing really strong bearish divergence. Now, what we've started to show here is as the NASDAQ broke down, we started to see the small caps showing the same level of weakness. And what we've got here is we've got a change of market structure. Now, it seems to be holding, and we might just be able to pull that back, but it is looking a little bit weaker than what the Dow Jones, for an example, is looking, or the S&P 500 is looking. So that's what we're seeing in the big indices. When I start to look at some of the big tech, so the hardware, what we're seeing with DRAM, dynamic RAM, is we definitely saw a breakdown. So what we had is we had a good support resistance level over here, which we lost a couple of weeks back. We then came down to the next big level of support, and we lost that 2 days ago, which was the day that the Fed were reaching their decision. But what we got after that was an incredibly strong bounce, and you know, DRAM was up 16.7% for the day, absolutely incredible. Now, what we need to watch is we've had a fair move down, but is that now the bottom? Have we got buyers ready to commit? Is it a buy the dip opportunity and this is going to go on to new all-time highs? Or do we look to get potentially rejected round about the sag zone? So this is the level that I'm watching. We obviously got this key resistance zone that we need to get through, but if we get through that, the 382 to the 618 retracement of the move down would be that potential zag zone that we look for, and that would be a suckers rally before we end up getting a further sell-off in that. The same sort of thing with semiconductors. When we look at the semiconductors ETF, we've had a really good run on the semiconductors ETF all the way from April 2025, and from April this year we've really gone parabolic. And we saw the big sell-off in the Korean markets. That was SK Hynix and Samsung, and they got hit pretty brutally. And what we saw is we saw the same hardware stocks, the semiconductor stock, getting the same sort of treatment in the US. Now, what we saw yesterday is we saw a massive gap up at open, and that continued to go up. And why? Because we suddenly become risk on, because we're not fearing a rate hike, not in the next 2 months, because the next time the Fed meets is September. So we put the rate hike on hold. And at the same time, we've also got really average GDP data that came through last night. Last night, GDP for Q2 came in at 1.5% for the US on an expectation of 2.1. So growth came in softer. So we've got a little bit of an unknown factor of what's happening with oil and the Strait of Hormuz and the whole war between the US and Iran. But what we've also got is we've got a weakening labor force, and we've got weakening growth, which really is bullish for markets because it indicates that the Fed won't rush to hike rates. And the Fed are still sitting there uncertain of whether or not they're going to hike rates. Now, looking at what the yields are telling us, the yields are certainly telling us that yields continue to go up. So we had inflation went up quite significantly, came down a little bit this last month, but that was because oil prices dropped, but oil prices are going back up now. So what will happen to inflation is really going to depend what the Fed do with their Fed funds rate. But what we're seeing is the 2-year, the 10-year, the 30-year yields go really, really high. And in fact, the 30-year US yield is now at the highest point that it's been since 2007, which was before the GFC crash. So we are in dangerous territory. The yields are shouting out to us that we are incredibly concerned in terms of where we are with inflation and where we are with fiscal government spending and where we are with government debt. All the yields are telling us that there's a major problem on the horizon that we're going to have to face into sometime or the other. But with the Fed decision of holding rates, we probably get to hold the market up for another couple of months until we understand what how things develop with oil prices, with the war, and how that affects inflation. Looking at what that means for the Australian market, the XJO is sitting here still in a bit of an uptrend. So what you can see here is we are still continuing to grind higher. Now, We haven't seen a phenomenal move in the XJO. We haven't seen the big moves like we've seen in the US markets. We haven't had that big tech tailwind that's been driving it. But what we've seen for a while here is we've ended up consolidating pretty much all of this year. We've sat really consolidating and going sideways. And what we're waiting for is we're waiting for a resolution. And because we're more finance driven, and it's not the time for finance and property with high rates, but also we're very resource driven in terms of how big our resource sector is in the ASX, is we're really waiting to uncap metals and materials, both precious metals, and we potentially coming into the near what looks like it could potentially be a bottom for gold and silver. But we're also looking not really for gold and silver to run now. Gold and silver might consolidate for a period of time before it's ready to break out into new highs. But what we are looking for is we're looking for the industrial metals to run. And if we become more risk on, and if we can start looking at not raising rates and start to stimulate growth, that will be incredibly good for industrial metals, especially considering that industrial metals have to pretty much do all the infrastructure build for the AI, automation, robotics, sort of innovation cycle that we've just started. We've just scratched the surface. But one of the biggest things that we're going to need for that AI, data centers, robotics, everything else is going to be energy. Energy is going to be the bottleneck, but we currently don't have the energy infrastructure built. So what has to come before energy is all of those copper build-outs and all the other supporting metals like tin and everything else that is going to go with the infrastructure build that will deliver the energy over the next decade, 2 decades, that will deliver the AI, robotics, automation, data centers that we know is going to be the future and it's going to dominate the growth over the next 2 decades. So when we look at the XJO, we are really waiting for a sign. Now we are busy sort of coming down into another sort of decision where, what are we going to do? And at the same time, our RSI is also narrowing. And what we're waiting for is a really good opportunity to probably retest support once more before we break out into the sort of next drive, and which ideally will be fueled by industrial metals. When we look at the risk sentiment, we can really understand the risk when we look at cap sizes. And what I've got in here is 4 lines that, I've looking back from earlier this year. We've got the XJO, which is the top 200 stocks. We've got the XMD, which is mid caps. So these are the large caps, these are the mid caps. Then we got small caps, and then we got micro caps. Now, when you start to look at it, the large caps and the mid caps are holding up really well. Why? Because they're big companies, they established, they got good cash flow, they don't have a lot of debt, and those are performing really well, even though in Australia, the RBA's just put up rates. What's not holding up is small caps and micro caps. Why? Because they don't have a lot of cash on hand. They sit with a very large debt to equity ratio, and with high rates, a lot of these smaller companies are not profitable. So what you're seeing here is a real clear divide between the large caps, mid caps, and then the small caps, micro caps in terms of what's performing in the Australian market. When we look a little bit broader into the sectors of the ASX, you can see there's a very clear pattern. There's the 2 sectors that have seen a lot of correction this year being information technology, so tech stocks, and healthcare. And healthcare is starting to look like it might have put in a bottom. And we could see, especially if we do go into a defensive period, we could see a bit of a move on healthcare. But currently what you can see is healthcare and tech have been the underperformers. They've been the laggards over the last year. And what has led the last year has only been energy and materials. So materials have run because gold and silver ran up. This move up here was predominantly gold and silver. What we've also had is we've had industrial metals, copper and tin and lead and zinc also starting to run a little bit. And what we've obviously had that's pushed energy up is from the beginning of the year we've had the war. And oil prices have soared, energy stocks have benefited while everything else have taken a little bit of strain. besides those four sectors, the two laggards, technology and healthcare, the two leaders, materials and energy, everything else has done nothing over the last year. So if you look at financials, you look at consumer staples, you look at utilities, you look at industrials, you look at consumer discretionary, you look at property, you look at telecommunications, they've done nothing all year, right? So what the trade has been, and this is the period that we're in a little bit of uncertainty. What are the Fed going to do? Do we have an inflation problem? Are we, we started to cut last year where we started to see materials running really, really nicely when rate cuts were starting to happen globally. But now, since the war started and Australia can't get on top of their inflation problem, we're starting to see the markets stagnate. And the markets are waiting for direction. We don't know if we're going to be risk on or risk off because we can't decide. Are we finished with contraction? Can we cut rates soon? Or is inflation coming back really, really hard because of oil prices in the Strait of Hormuz? And that means that we're actually going to go back into a contraction phase with higher rates for longer. So what we're doing right now is the market is split. You have the laggards, you have the leaders, and the majority of the market is actually doing nothing. So it's not a time to force trades. We certainly are seeing a nice bounce and a nice recovery in the US markets. We don't know if that is just going to be a short-term recovery bounce before more downside, or if it's going to be sustained. I think what happens in the war, what happens between US and Iran, when the Strait of Hormuz, does that reopen? Does it close down? All of that together with what the Fed and the ECB and the BOJ start to do around rates over the coming months will give us a direction. At this moment of time, it's a great time to just probably sit on your hands. Don't try and throw you when it is going to be time to move. I hope that was helpful. Have a great week. See you next week. Bye.